Welcome to today's show. I am your host, Eric Darnley Small. And on today's show, we're going to do something a little bit different. Although politics colors everything, I want to sort of capture for a moment the state of the economy and what people are saying, what people are predicting, what people are thinking about the economy as we begin this transition to Trump. Trump is inaugurated on Monday, and the new era begins then. And I just want to take an opportunity because people are beginning to look forward, and they're also looking at where we are today. And it's not a deep analysis of the Biden administration and of the Bidenomics. I don't know if I'll do a video on that or if it's worth it at this point in time. There's so many places you can go. But I just want to put on the record, for the record, where the business people are and where the market is and where the bond market is, and talk a little bit about a cognitive dissonance. Because if you've got money right now in the market, or you're thinking about buying and making purchases and all that kind of stuff, you know, interest rates are what they are, and you're looking at your future. I have said in a previous video that you should be very careful about doing any spending, large spending, because of what could go wrong if Donald Trump gets everything that he's proposing, and what people are speculating and saying about, you know, mass deportations and how that's going to have an effect, as well as the independence of the Fed and under Donald Trump, and how that's going to have an effect going forward. So that's going to be the focus of today. I just want to put on the record as to where the economy is and where people think it's going, and then we're going to check in on that as the Trump administration goes forward. Just a reminder to people, if you like what you see, if you like my videos, please consider liking and subscribing to the video, as well as clicking the bell so that you are notified when new videos are uploaded. In addition, I'm going to talk about some articles, and I'm going to give you my opinion of what I think is happening. But I encourage you to go and take a look at those articles yourself. You can find links on our Mastodon at mastodon.vtit.me/@ what you missed. And you can take a look, read the full articles for yourself, and come up to your conclusions, and we'll go from there. So today's episode is about business and the economy. And in general, what to remember when things go south, is as I like to call it. Because as much as I loathe sort of sitting back and rooting for disaster, I also think forewarned is forearmed, and that we have to be prepared going forward as to what to do, so that we know what to do and that we're fully prepared for what is going to happen. One of the things that I think is important to look at is where the business community is, right? Donald Trump's election, winning the election, as expected, anytime a Republican wins, people call it, quote unquote, good for business. We know when George Bush won, Hank Paulson was Treasury Secretary, that was good for business, and we know how that turned out. So whenever things are good for business, be warned that, you know, they're setting up to do a lot of things like huge tax cuts, increased deficits, mergers and acquisitions, and to begin to gut regulations, things that are there to protect America in order to be good for business and to be good for America. I said in previous video, expect payday loans to come back, expect weakening of regulations for banking and all that stuff. So this Goldman Sachs CEO is saying that the Trump era is good for business. That should be a warning sign for anybody and who's interested in making sure that they're safe financially going forward. That means put your money away and be very careful about what you're spending. There's been a meaningful shift in CEO confidence since Trump's election, says Goldman Solomon. That's the CEO. His name is Solomon. This is from CNBC online, January 15th by Jesse Pound. And I'm going to read this article right now. It says, the election of Donald Trump in November and the swing back to Republican power in Washington is already starting to make an impact in the business world, according to Goldman Sachs CEO David Solomon. There's been a meaningful shift in CEO confidence, particularly following the results of the U.S. election, Solomon said, according to a transcript from FactSet. The comments line up with some survey data that suggests renewed confidence among business leaders. The latest Chicago Fed survey of economic conditions showed an improved outlook for the next 12 months. The NFIB Small Business Optimism Index rose to its highest level since October 2018 in December. But executives on JP Morgan Chase earnings call said that the optimism among business leaders has not yet resulted in loan growth, according to a FactSet transcript. Stocks rose sharply in the immediate aftermath of Trump's win as investors cheered the prospect of lower taxes and fewer regulations. However, many of those gains have since disappeared in part due to a recent rise in interest rates. Let me also point out what is important again is that the common thinking has always been, and the axiom within the Republican Party is what's good for business is good for America, is good for its people. And that's trickle down. Those businesses' success will trickle down to the rest of us. Nothing in this indicates that any of that is possible. Deregulation and these other things, these quote unquote good for business, and the historical record has not indicated that that has ever been good for America, which is what Trump believes and the Trump supporters believe. To that end, with the election of Trump, Goldman predicts a lot of M&A. Also from CNBC's Sean Cullen, this new trading year could bring a boom in mergers and acquisitions, and some stocks may be poised to benefit. According to Goldman Sachs, the number of completed M&A transactions in the U.S. could rise by 25% in 2025. This comes as Wall Street has been preparing for a revival in M&A activity with the inauguration of President-elect Donald Trump, whose second term is expected to be more business-friendly. In light of that forecast, Goldman has screened for stocks that it thinks have a chance of undergoing a merger. In particular, the firm has broken out stocks into two groups, with one cohort including names that have a 30% to 50% chance of facing a merger, and the other including those that have a 15 to 30% chance of a merger. So mergers and acquisitions do not help the average American. In other words, none of your benefits are going to increase. None of your, prices are going to go down. None of those things are going to happen. What's going to happen instead is that businesses that become conglomerates become a monopoly, and that's always bad for the American people. Lena Khan is leaving. Lena Khan blocked famously the merger of Albertson and Kroger, I think it is, two of the largest supermarkets. Whenever you have these things merge into one, you have these monopolies. Monopolies is always bad for the average American. In addition, when a contagion or when something bad begins to happen, you build back too big to fail. So bailouts become a necessity for these big companies because they're so large, they employ so many people, there is no competition, that you can't allow these businesses to fail. I think that if you invest in those businesses, that ends up being a good thing for you because your investment is safe no matter what, because you know the government's going to come in and bail them out. However, it's bad for the American, it's bad for America, it's bad for the American worker, it's bad for the economy. And again, this is something that Donald Trump and the Trump supporters are going to have to deal with along with the American people if anything goes bad going forward. This is from Paul Krugman. Is there an insanity premium on interest rates? This is a fascinating article. Krugman has left the Times. He now has a Substack. And this is from January 8, 2025. And this is an article by Paul Krugman himself. And it says, quote, "The Fed only controls short-term rates. In fact, its target, the Fed funds rate, is an overnight rate on loans between banks. Yet the interest rate that matters for people's lives are long-term rates, rates on the 5-year car loans, 10-year corporate bonds, 15 to 30-year mortgages. And a funny thing has happened to those longer rates. They've gone up. Since the Fed began cutting, the benchmark 10-year Fed bond rate has risen by roughly the same amount the Fed funds rate has gone down. This divergence is unprecedented. There's nothing inherently paradoxical about short-term rates and long-term rates being different. or even moving in opposite directions. An investor choosing between a short-term and a long-term investment is always making a bet on future interest rates. For example, at the end of 2024, a one-year CD paid an average of 1.76%, while a three-year CD paid 1.43%. Did this make the 1 years a better buy? Not if you expect rates to fall in the future. So that you should lock in that 1.43% while you could. So if long rates were rising even when the Fed was cutting, it could be because investors are revising their estimates of future Fed rates upward. But why would they do that? For what it's worth, businesses who presumably are closer to the ground than the rest of us don't see disinflation stalling in the near term. The 10-year Treasury rate might reflect the horrible creeping suspicion that Donald Trump actually believes the crazy things he says about economic policy and will act on those beliefs. Look at the dynamic over the past few days. Jeff Stein of the Washington Post reported that people around Trump were planning a fairly limited strategic set of tariffs rather than the destructive trade war against everyone Trump has been promising. Trump quickly responded with a Truth Social post calling the report fake news and declaring that he does too intend to impose high tariffs on everyone and everything. In short, sources quote, Trump isn't as crazy as he look. Trump, quote, yes, I am. What does this have to do with interest rates? There's near unanimity among economists that Trump's announced agenda of high tariffs, tax cuts, and mass deportation would be highly inflationary, although probably not right away. Whatever Trump does, inflation will probably remain low for much of this year. Still, if he were to go through with any of the substantial part of his agenda, the Fed would definitely have to put further interest rates cuts on hold. In fact, it might well feel the need to raise rates again. Trump might well demand that the Fed continue cutting rates. Many economic students learn about how Richard Nixon pressured the Fed to keep rates low before the 1972 election, despite growing inflation concerns. The end result was to help send inflation and interest rates soaring. But you may ask, if bond investors are worried about the madness of Trump 2.0, why are stocks up? I'd offer two possible answers. One is that stocks and bond investors are different. The former are a lot more limbic, i.e. lizard-brained. Everyone knows about meme stocks, which soar because of frenzies on social media. I haven't heard of any meme bonds. The other is that the recent rise in stocks is rather narrow. Arguably, it's mainly about AI. The Dow, which can be seen as a proxy for the non-AI economy, has already given up almost all of the Trump bump. Those of us horrified by Trump's ascent would like to see him punished by the markets, but we shouldn't expect instant gratification. It may well be years before the consequences of his economic delusions are really obvious, but rising interest rates, even as the Fed cuts, may be an early sign of things to come. So, once again, the problem is not going to manifest itself probably until the end of Trump's second term. So the disaster that is coming is not going to be straight out the door, but it's going to be a slow breakdown over time. I said this in previous videos. From what I've heard reported is that the tariffs, the effects of tariffs are not going to be felt down the line, although businesses now under the Biden administration are already beginning to raise prices in anticipation of these tariffs. So people are not going to feel the tariffs on day one when Donald Trump comes in, the effects of them. But within a year, 2 years, that's going to be more the case. That's what Paul Krugman is saying here as well. In addition, the breakdown and the, take, for instance, if he succeeds in getting rid of the Affordable Care Act and begins to bring back low-cost healthcare that has very little healthcare in it. It is basically a catastrophic plans. That's going to bring down rates dramatically, and people are going to love that. And there's also, I said in my previous video, the broken heart of America, what I call the broken heart of America, is that basically I want to see the other guy suffer while I'm still get my benefits. Screw that other guy. And the notion of insurance is that everybody has to buy insurance because we all subsidize each other. That's why it's a socialist kind of ideology. Insurance is that my premiums are low because I'm healthy. My premiums are high even though I'm healthy, because my neighbor's premiums remain stable or remain at the same level as mine, even though he's unhealthy, right? So the cost is basically spread out through us all, right? Healthy and unhealthy alike. And there's more healthy people out there, hopefully, than there are, unhealthy, so that everything sort of evens out in the end. But when you begin to start pooling people who are all sick in plans, in catastrophic plans, things get lost. And one of the things that's going to go away, I believe, is the individual mandate. And one of the things that's going to go away is that everyone be covered, even if they're sick, so that mandatory covering everyone for all illnesses. Those are the kinds of things that are going to go away because they're going to be business friendly. However, it's going to be a return back to where we were, where a large number of people who become ill or become sick because of the next pandemic, for instance, are going to go bankrupt. People are already going bankrupt, but it's going to be worse than it was before the Affordable Care Act. We're going to start seeing cheaper plans with very, very little coverage for if you get cancer, if you get really ill. Those kinds of things you're not going to see in the beginning. It's going to take maybe 4 years for you to see it and for it to happen. But the stories are going to get out there of people who develop breast cancer, MS, other diseases that their insurance company, because they have these they're in these risk pools, or there's these insurance companies that don't cover everyone, that don't cover all illnesses, that are just not going to cover them. Similar to what we're seeing with the fires in Los Angeles right now, where Allstate pulled out of Los Angeles last year. And those people who don't have coverage, who are going to risk without coverage, or who probably had a coverage plan that was lesser than what they would normally have had, years ago, they're going to go bankrupt, and they're going to lose everything, unfortunately. So that is going to be the new America, a return back to the way things were. As long as people think that if it doesn't happen to me, that's not my problem, I think that people are going to be happy with that until bad things begin to happen, and until the financial industry. We had this guy kill a healthcare executive over healthcare, and people were rallying behind him. Yet they put Donald Trump and RFK Jr. to head the government, another billionaire, as if they think that they're going to do something about it. So cognitive dissonance, a lot of unclarity about where the American people are, and we're going to see it going forward. After January 20th, the House is already passing some crazy stuff, and expect that to come forward. So forewarned is forearmed. Thank you for joining me on today's show, and you will see me on the next one. Take care, everybody. Hey there, fantastic viewers. Eric Darnley Small here, and I hope you're loving today's episode of What You Missed. You've reached the end of today's show, but don't worry, there's more show coming up. If you're watching this on YouTube, please click the bell so that you'll be notified when more content is available. You can also help the channel by clicking the like and subscribe buttons. It helps the YouTube algorithm find new viewers so that I can keep bringing you all this incredible content you enjoy. But wait, there are more ways to support the show. You can make a contribution through the show's PayPal, which goes a long way in helping produce even better content for you. And consider becoming a part of our growing community by joining our Mastodon site at mastodon.vtip.me/@whatyoumissed for more engaging discussions and exclusive updates. And here's something you won't want to miss. Mark your calendars for our live show streaming on YouTube and stream.vtip.me Monday mornings, 10:30 a.m. Eastern Standard Time. Your support means the world to me, and together we're making What You Missed the best it can be. Thanks for being a part of my journey.